Picture this. You open your bank app. You see your balance. Maybe it's $5,000. Maybe $50,000. Doesn't matter. You close the app, and then, out of nowhere, a number pops into your head. Not your balance, a different number. Something like, is this actually safe? Most people shake that thought off and go back to scrolling. You've probably done it too. But here's the thing. That gut feeling you dismissed? Some of the most powerful financial institutions on the planet are acting on it right now. Not in theory, not in speeches, with planes, with armed escorts, with months of classified logistics. I'm not talking about a conspiracy. I'm talking about something that's showing up in official government reports, central bank press releases, and statements from named economists at places like the Bundesbank, Germany's version of the Federal Reserve. What they're doing, quietly, without most people noticing, is pulling their gold out of vaults they've trusted for decades. Countries are literally flying their national reserves home on cargo planes with military security. And the reason they're doing it? It changes how you should think about every single dollar you have sitting in an account somewhere. Today we're going to walk through exactly what's happening, where, why, and what a regular person can actually do about it.
Here's what most people assume. Gold is just an old-fashioned investment, something your grandparents cared about. Irrelevant in a world of index funds, crypto, and high-yield savings accounts. And honestly, for most of the last 30 years, that was a reasonable assumption. But here's what changed, and I want you to understand this because it explains everything else in this video. In 2022, the United States and its allies froze $300 billion in Russian foreign reserves. Just locked them. Countries that had been storing their national savings in dollar-denominated assets woke up to a new reality. The money you park in someone else's system can be taken away. Not stolen, frozen, but the practical effect is the same. You can't touch it. Now, most people heard that news and thought it was about Russia, but every central bank on the planet heard something different. They heard this can happen to anyone. That's when something started shifting, quietly, behind closed doors, in rooms where finance ministers and central bank governors sit around tables and ask uncomfortable questions. Here's what most people don't realize. Gold stored in a foreign vault isn't really yours in a crisis. It's a diplomatic promise. And when geopolitics get complicated, as they have over the last 3 years, that promise starts feeling a lot less solid. So what have central banks been doing? They've been buying gold at the fastest rate since 1967, and more importantly, they've been bringing it home. According to the World Gold Council's full year 2025 report, central banks around the world purchased 863 tons of gold in 2025 alone. That's on top of over 1,000 tons per year for 3 straight years before that. And their own survey showed that 95% of respondents expect global official gold reserves to keep increasing, the highest level of optimism in the survey's 8-year history. But here's the part that changes the whole picture. It's not just how much gold they're buying, it's where they're choosing to keep it. 68% of central banks now plan to hold their gold domestically, in their own country, up from just 50% 4 years ago. In a single year, the percentage actually holding gold at home jumped from 51% to 59%. That's not a portfolio adjustment. That's a fundamental change in how the world's most sophisticated financial institutions think about safety. And when you understand why they're doing it, you start to see the whole financial system a little differently. Because the system has a crack in it. Not a small crack, a structural one. And it's showing up in the place you'd least expect. London, the gold capital of the world for over 3 centuries. We're going to get into that in a minute, but first, let me show you what's actually happening on the ground, because the specifics of what India, Germany, and Poland have done in the last 18 months are more dramatic than anything you've read in a headline.
Let's start with India, because their story is the most cinematic one here. Go back to 1991. India was in a genuine financial crisis, the kind where lights out felt possible. Foreign exchange reserves had dropped to just $1.2 billion. That's barely enough to cover 2 weeks of imports. The country couldn't pay its bills, so the government did the only thing it could do.
It physically shipped 67 tons of gold to the Bank of England in London as collateral, basically as a promise to pay back a loan. It made the front pages. It was a national embarrassment. Indian politicians called it a moment of shame. Fast forward to 2024. India didn't just pay back that debt, it reversed the entire story. The Reserve Bank of India repatriated 100 tons of gold from UK vaults in May 2024. Classified operation, specialized aircraft, months of planning, zero public announcement until it was done. Then, in October 2024, they did it again, another 102 tons, flown home under complete secrecy. Between March 2025 and September 2025, the RBI brought back another 64 tons. Total over 4 years, 274 tons repatriated back to India, according to the Reserve Bank of India's own half-yearly report on foreign exchange reserves published October 2025. Here's what that looks like in plain numbers. In 2022, roughly 38% of India's gold was held domestically. As of September 2025, that number is 65%, an all-time high. And gold's share of India's total foreign reserves has climbed from 8.1% in March 2024 to 13.92% by September 2025. That's not a trend, that's a statement. Most people see gold repatriation as a financial move, but India's finance minister put it in plain language when asked. The RBI is taking a very considered decision to diversify reserves. Translation, they don't want all their eggs in someone else's basket. But here's where it gets really interesting. Germany is the second largest official gold holder in the world, 3,352 tons, worth approximately $460 billion as of early 2026. Here's the problem. Roughly 37% of that gold, about 1,236 tons, is sitting in vaults at the Federal Reserve Bank of New York in Manhattan. And Germany doesn't actually have immediate access to it. It's stored there for historical reasons dating back to the Cold War, when keeping gold in the U.S. made sense as protection against Soviet invasion. That made sense in 1960. In 2026, the calculus looks different. In January 2026, Emanuel Monch, the former head of research at the Bundesbank, Germany's own central bank, went public with a statement in Handelsblatt, Germany's equivalent of the Financial Times. He said, "Given the current geopolitical situation, it seems risky to store so much gold in the U.S." He suggested the Bundesbank would be well advised to consider bringing it home. That wasn't a fringe opinion. Politicians from across Germany's political spectrum, from the center-right CDU to the Green Party, began publicly echoing the same concern. Katharina Beck, the Green Party's finance spokesperson, said the gold must under no circumstances become pawns in geopolitical disputes. Germany isn't the only one. Italy, the third largest official gold holder with 2,452 tons, is facing the same pressure. Germany and Italy together have approximately $245 billion worth of gold sitting in New York vaults. Now, to be fair, the official German government position is that repatriation is currently not on the agenda. Some economists warn that hasty repatriation could complicate diplomacy. This isn't a one-sided debate. But the fact that the conversation is happening at all, across party lines, among senior economists, in mainstream financial newspapers, tells you something important about how the geopolitical mood has shifted. Most people assume the money in other countries' vaults is just there, safe, neutral. But what happened to Russia's $300 billion is a reminder that financial assets are never truly outside of politics. But here's what changes everything. While India and Germany get the headlines, some of the most aggressive gold buying has come from a country you might not expect: Poland. The National Bank of Poland was the single largest official gold buyer in 2025 for the second consecutive year. They added 102 tons in 2025 alone. Their total reserves now stand at 550 tons, and Governor Adam Glipinski has already announced intentions to push holdings towards 700 tons, explicitly citing national security reasons.
Poland's goal is for gold to represent 30% of its total official reserves. That's more than double the global average for most developed nations. Why? Poland sits at the edge of Europe. It has a clear strategic view of geopolitical risk that countries further west might not feel as urgently, and their response is to own more tangible, non-digital, non-freezable assets. They're not alone. Kazakhstan hit a record level of annual gold buying in 2025. Serbia has announced a target to nearly double its holdings to 100 tons by 2030. At a recent London Bullion Market Association conference in Kyoto, both Madagascar and South Korea signaled plans to increase their reserves. This isn't a niche trend. According to the World Gold Council's 2025 Central Bank Survey, 95% of central banks expect global official gold reserves to increase, the highest reading in the survey's 8-year history. A record 43% said they plan to increase their own holdings, up from 29% in 2024. When 95% of the world's most sophisticated financial institutions agree on a direction, that's not speculation, that's a consensus. But here's the part nobody is talking about. London has been the global center of gold trading for over 300 years. The London Bullion Market Association sets the standard for how gold is bought, sold, priced, and delivered worldwide. And as of early 2025, it started showing cracks. Here's what happened. When Donald Trump won the 2024 election and began signaling aggressive tariff policies, traders got nervous that gold might be included in import tariffs. So they started moving physical gold from London to New York, specifically to COMEX vaults, to get ahead of any potential duties. Between November 2024 and January 2025, 393 tons of gold were airlifted from London to New York. COMEX inventories surged 75% as a result. The effect in London? Delivery timelines collapsed. The standard in London had been next-day settlement. You ask for your gold, you get it the next business day. By January 2025, the Financial Times and Reuters were both reporting that delivery timelines had stretched to 4 to 8 weeks. Weeks for gold that's supposedly sitting right there in the vault. The Bank of England reportedly had to ask other central banks to lend it gold stored in its own vaults just to fulfill existing withdrawal requests. Think about what that means. The vault that holds everyone else's gold is borrowing gold to cover deliveries. Now, here's the deeper problem. According to analysis cited by multiple bullion market sources, London vaults hold approximately 279 million ounces of gold on paper. But the float, the gold actually available for immediate delivery, is only around 36 million ounces. Meanwhile, there are an estimated 380 million ounces worth of outstanding contracts. In other words, there's more paper gold than there is real gold available to deliver, by a factor of more than 10. Most people assume that when you buy gold in a financial product, an ETF, a futures contract, a gold account, there's a bar of metal somewhere with your name on it. In most cases, there isn't. It's a promise backed by another promise, which is fine until everyone asks for their gold at the same time. This isn't a conspiracy theory. The Bank of England governor testified about this in front of the UK Treasury Committee in January 2025. The Financial Times covered it. The LBMA's own data confirms the inventory drawdown. And this is exactly why central banks aren't just buying gold, they're insisting on holding it physically within their own borders, because they've done the math on what paper promises are worth under pressure. But here's the part that matters for you.
Gold set 53 new all-time highs during 2025, according to the World Gold Council's full-year 2025 report. The average price for 2025 was $3,431 per ounce, a 44% increase year over year, the strongest annual gain since the late 1970s, according to the World Bank's October 2025 Commodity Markets Outlook. As of early 2026, gold has pushed past $5,000 per ounce. Most people look at that and think, I missed it. That's the wrong frame. Here's the right frame. Gold is not a hot stock that went up and is now overpriced. Gold is a reflection of something broader, the declining confidence in the system that manages everyone's money. When central banks, the institutions that literally print money, are buying physical gold at record rates and flying it home on cargo planes, they are sending a message, not in press releases, in actions. The World Bank projects gold prices to reach new all-time highs again in 2026. ING analysts say gold's main drivers, central bank buying, Fed rate uncertainty, dollar weakness, and geopolitical risk, are all still firmly in place. Amundi Research's target for gold in 2026 is $4,200 per ounce. These are not gold bugs talking. These are mainstream financial institutions that manage trillions of dollars. And here's the thing most people miss about all of this. The central bank run on vaults isn't just a story about gold. It's a story about what happens when the institutions that manage the global financial system stop fully trusting each other. And when that trust erodes at the top, the effects travel downward to your bank account, your savings, your purchasing power. You don't have to panic about that, but you do have to understand it, because understanding it is what lets you make decisions instead of just reacting. So let's zoom out for a second and think about what this looks like 10 years from now. There are two versions of the next decade, and they're not that different in terms of what you do today, but they're very different in terms of how prepared you are. Version 1. Most people do nothing. They keep all their savings in the same currency, the same bank, the same country. They assume the system works the way it has always worked, that their dollars are safe, that their accounts are accessible, that inflation will stay manageable. That might work out fine, or it might not, and if it doesn't, the window to act will have already closed. Version 2, a smaller group of people notice what the most sophisticated financial institutions on Earth are doing, and they start making small, deliberate adjustments. Not dramatic ones, not liquidating everything and moving to a farm, just diversifying in a smarter way. Owning some things that can't be frozen, inflated away, or blocked by a policy decision made in a foreign capital. Most people 10 years from now will remember 2025 and 2026 the way people who didn't buy real estate in 2012 remember that window. They'll say, the signals were there, they just didn't know what to look for. The people who are paying attention now are doing something different. They're not following a hype cycle, they're following a pattern. The same pattern that central banks, sovereign wealth funds, and institutional money managers have been following for 3 years running. That pattern is when political risk rises, when trust in institutions weakens, when the gap between paper promises and real assets grows wider. Tangible assets hold their value, while everything built on promises starts to slip. Gold is one part of that picture, but it's not just about gold. It's about understanding what kind of assets hold their ground when the system gets stressed. Think about it this way. If your savings were entirely in one currency, say the Lebanese pound or the Argentinian peso, and that currency collapsed, your savings would collapse with it. Now you're in the US, the dollar isn't the Lebanese pound, but the same principle applies at a smaller scale. Concentration is risk. Diversification across asset types, across jurisdictions, across physical and digital is how you reduce exposure to any single point of failure. The institutions that understand this best are central banks, and they've been voting with gold bars and cargo planes for 3 years. The question isn't whether this is happening. It is. The question is whether you're the kind of person who notices signals before they become obvious or after.
Here's the thing I want to leave you with. None of what we talked about today requires you to believe the system is about to collapse. It doesn't require you to be pessimistic or to distrust banks or to think the dollar is going to zero. It just requires you to ask, am I as diversified as the institutions that manage the world's money? Am I holding assets that can survive a range of outcomes? Not just the best case, but the messy middle ones. Central banks aren't panicking, they're adjusting. Thoughtfully, with long time horizons, and the adjustment they're making is less exposure to promises,
more exposure to things that exist physically. You get to decide what the right version of that looks like for your life. Maybe it's allocating a portion of your savings toward physical precious metals. Maybe it's paying down debt that locks you into a fixed burden. Maybe it's thinking more carefully about real estate as an inflation hedge. Maybe it's just educating yourself enough to have a real conversation with a financial advisor about these dynamics. But the worst thing you can do with information like this is nothing. Not because crisis is certain, it isn't, but because the cost of being slightly more prepared is low, and the cost of being completely unprepared is not. The run on the vaults has already started. The question is what you do with that knowledge.